SPACs are shell companies with no actual commercial operations but are created solely for raising capital through an initial public offering or IPO to acquire a private company. This is done by selling common stock, with shares commonly sold at $10 apiece, and a warrant which gives investors the preference to buy more stock later at a fixed price. Once the funds are raised, they will be kept in a trust until one of two things happen. First, the management team of a SPAC, also known as sponsors, identifies a company of interest, which will then be taken public through an acquisition using the capital raised in the IPO. Or second, if the SPAC fails to merge or acquire a company within a deadline, typically 2 years, the SPAC will be liquidated and investors get their money back.
Hi guys, it's Steve from Disruptive Wealth Creation. Today we look at what are the advantages and disadvantages of a SPAC, what makes a good SPAC and what makes a bad SPAC, and then finally we'll look out for the red flags so we can identify the bad SPACs. The purpose of a SPAC is to bring a private company into the public domain. There are two ways of doing this, the traditional way and the SPAC way. More and more companies are taking the SPAC route. So let's find out why. Firstly, companies like SPACs because they can IPO quicker and more efficiently. Traditional IPOs can take 1 to 2 years, whereas SPACs can be done within 3 to 6 months. Secondly, SPACs have less demanding regulations, which makes them less burdensome and cheaper. Thirdly, a private company can agree a price for a merger with a sponsor quicker, and it's less complicated than the traditional IPO valuation. Now let's have a look at why institutional investors, millionaires and billionaires, also known as whales, like SPACs. In essence, they can make a safe bet and not lose. Firstly, they have the right to redeem the shares they purchased with interest if they want to. So it's a kind of money back guarantee. Secondly, it's a risk-free bet. If the company is doing well, the big investor will keep their money and they have the option of buying more shares at a discount. If they're doing bad, then they can sell their shares and get their money back with interest. So what about the sponsors who manage the shell company? Well, they get a 20% stake in the SPAC for a minimal investment. They earn this money by finding a company to IPO. Like the big investors, they are in a win-win situation. Even with a small stake like $25,000, they can make millions of dollars. Even with a bad deal, they can make lots of money. Often they will continue with a bad deal rather than liquidate the company. We all know that there's no such thing as a free lunch. So if it all goes bad, who suffers? Well, it's people like us, the small retail investor. So let's have a look at some good SPACs in 2021, have a look at some bad ones, and then see if we can identify the red flags when it comes to investing in SPACs. If we look at the statistics, in 2020 there were 248 SPACs issued. Last year, in 2021, it doubled to 498 SPACs. Many people who invested and won and lost money were enticed by the backing and endorsements of high-profile sugar candy celebrities. Here are two examples of winners. They include the Polestar Electric Company, backed by Leonardo DiCaprio, and then secondly, Aurora Innovation, a driverless company linked to the founder of LinkedIn named Reid Hoffman. Two examples of losers include the Beachbody fitness company backed by Jay-Z and a company called 23andMe, which records DNA and was backed by Richard Branson. So what should we be looking out for? What are the red flags? Well, we all want to get in early on the startups and make money, but there can be problems. Firstly, the SEC identified that SPACs are not properly disclosing all the risks. A good example of this was Nikola, which was accused of lying about the strength of its project and its technology. Secondly, companies being acquired often overstate their projections. There have been numerous lawsuits of SPACs making misstatements. Thirdly, where SPACs have failed to live up to their projections, they often plummet. And then lastly, a 2-year deadline means that sometimes companies will make a bad deal in their rush to get listed. So when the next SPAC company is listed for IPO, think twice. What most people do is wait for the company to get listed, and then when the price settles, they buy into it. This is just my personal opinion. Happy investing, and thank you for watching.